Well, good evening, everyone, and a very warm welcome to you wherever you are in the world this evening. Thank you very much for joining us. I am Susanna McClintock, the Investment Director at Sustainable Ventures, and I'll be hosting this evening's event. Every year when we are raising for our Sustainable Accelerator Fund, we usually run drop-in sessions at our office, and so people that want to find out more about the fund can come in and meet us and see our workspace and meet some of our portfolio companies. Obviously this year we're not able to do that, and as a way of trying to bring people together and meet us as a team and meet portfolio companies, we've been running this series of online events, giving investors a chance to meet us and perhaps learn more about us and Sustainable Ventures. Obviously, virtual socializing is quite difficult in large numbers. So this event this evening is going to take the form of a panel discussion with the Sustainable Ventures investment team. We're going to run the event from 5 through to about 6 o'clock. We'll certainly finish by 6. And the event will have 3 parts. So a quick introduction to Sustainable Ventures and Sustainable Accelerator. And then the main part of the evening, a discussion with our investment committee on the learnings that they have experienced from the past 3 funds that we've invested, and also from their long-standing backgrounds in investing, and a forward look at their views on themes and investment strategy for our new fund, Sustainable Accelerator 4. And then we'll leave some time towards the end to take questions from you. We'd love you to ask questions of the team to give you more of a chance to hear from them. I think you'll find that you are muted, but if you could put your questions into the chat box, and that will help us to moderate the Q&A session, and we'll try to get to all of those towards the end of the evening. And just to let you know that we are recording the event to share with those people that have been unable to join us this evening. So to introduce Sustainable Ventures, our vision is a world in which climate change and resource scarcity are addressed through commercial solutions. And we do this in a number of ways, through sector specialist support services, through early stage investing in our Sustainable Accelerator Fund, and through creating an ecosystem to support startups across London in our 2 co-working spaces and more broadly. We talk about climate change and resource scarcity as our overarching themes, but it can sometimes be hard to contextualize that, what exactly that means. And people sometimes ask us, what do you mean by sustainability, or how do you define it? And so to help with that, we focus on 5 sub-verticals, which we see as the key thematic areas that contribute towards our vision. And those are food and agri-tech, mobility, future energy, building technologies, and the circular economy. And we work with companies across all of those verticals. Just a bit around Sustainable Accelerator's investment thesis. This is built on 4 key pillars. We de-risk businesses through our tailored Sustainable Accelerator support program. So our fund is a combination of both equity investment and support to startups. Our network of startups, including the Sustainable Workspaces community, which I mentioned, as well as the other Sustainable Ventures incubator programs that we run, give us really proprietary access to many early stage businesses and allow us to invest in a really high quality pipeline and create a strong and diversified portfolio. We're an SEIS EIS fund, and those tax benefits common across early stage investing, as well as the significant government grants that are specific to our sector, both create leverage and protect investor downside risk. And by investing early, that allows us to capture equity stakes prior to a growth inflection point that can deliver superior returns compared to the more standard venture capital or private equity investments. And to date, we've raised and invested 3 funds. We've made 22 investments across those 3 funds, and we're really proud that 21 of those investments are still operational. We're also very proud that from our initial investment of £2.5 million across those 3 funds, those companies have gone on to raise more than £24 million in further funding. So almost 10 times from our initial investments. As I mentioned, we're currently raising our Sustainable Accelerator 4 live on Cedars. We're delighted that we've passed our minimum funding target the week before last, and we're currently just over 740,000. As in previous years, we plan to leave that campaign open in overfunding, as we'd really like to raise a similar amount as we have before, so somewhere between 800 and £1 million, so that we can invest in a number 6 to 8 really high quality startups from the fund. So on to the main event of the evening. I'm delighted that we have with us this evening all 3 members of our investment committee, Andrew Wordsworth and Chris Morris, the founders of Sustainable Ventures, and Peter Short, our independent chief investment officer. I'm really looking forward to talking to them. And just whilst I stop sharing, we will do what's now become kind of regular in these events, the panel Are You With Me wave, as we try to find them. Are you all there? Yeah, very good, very good. Just bear with me 1 second. Great. Okay, so Chris, Andrew, Peter, thanks for joining us for this kind of panel style chat. This is our 3rd Meet the Investment Team session. In previous sessions, we've spent quite a lot of time talking about how the coronavirus pandemic has impacted our portfolio companies. And we thought in this 3rd session, as we approach the close of the current Sustainable Accelerator fundraise, and we're thinking more about the new investments that we're going to make from that fund, it would be maybe more interesting to look now at a more forward-looking conversation, and also to reflect on kind of how what we've learned over the past 4 years of investing our previous funds will inform our investment thesis for the new fund. While some would still consider that our target market is really quite niche, there's actually been quite significant changes, especially from an early stage investor perspective, where clean tech venture capital once, and certainly when I started working in it, essentially meant investing in wind turbines or anaerobic digestion plants, and those things were considered really risky. They're now the mainstay purview of large corporates and energy companies, and it leaves space for us to be looking at more cutting edge what are now considered new technologies of today. To start with you, Andrew, and just ask you, what do you see as the next big innovation themes for our sector, and how do you see that informing our investment thesis for the coming year, both based on those themes and what you've learned from your experience, both investing over the past 4 years, Sustainable Accelerator funds, but also from your many years of investing and working in this space in other organisations?
Thanks, Susanna. So yeah, if I pick up on I guess the sort of the innovation themes. One thing that's it's not unique to the sector, but is that the sort of the trends come from various different sources. They always come from sort of startups we're seeing in terms of applications and so on. They also come from, as many people in the news this week, big government announcements and big sort of government policy of setting kind of regulatory pressures and so on. We're also, you see it coming from corporate demand, for example. So what are they looking at and thinking about in terms of their next product set? I think I'd add to Susanna's introduction, the Sustainable Accelerator doesn't sit in isolation. It works with the wider set of sustainable ventures activities. So we see those. We've got a program called Better Futures, which is funded by the Greater London Authority, and that allows us to work quite closely and see companies at the really early stage. So probably maybe even 1 or 2 years before they would be eligible for the accelerator. And so yeah, so coming one big thing that's coming from them is the sort of circular economy. Obviously, the kind of Attenborough effect we saw quite a lot on in terms of single-use plastics, but it goes beyond single-use plastics, and so we're seeing a number of startup companies looking at other materials and other sort of where sort of resources going to be scared, resource scarcity and so on, and so we actually sort of pick those companies up very early on, far earlier than any sort of conventional VC would do. And so, but what's interesting is it's not just materials in terms of circular economy; it's kind of business models as well. And so, if you look at the portfolio, we've got companies like New Wardrobe from the second portfolio company, Good Club from the first cohort, all attracting funding, all secured funding fairly in the last 2-3 months. As take Good Club for example, in terms of the kind of online curated sustainable groceries, and obviously in this current sort of online boom, they're benefiting massively from that. But taking those and sort of sort of creating those kind of sharing environments and so on, they have the characteristics of a classic sort of tech investment in terms of being a platform. As they sort of prove their business model, it's very easy to invest to scale them up, and so we're very hopeful about those kind of things. And I think there'll be more of people identifying other areas where sort of resources being wasted, and how do you sort of share that or reuse that. And then obviously in terms of so going back to sort of government announcements, yeah, I think one of those, obviously it's very difficult to sort of pick through I think Boris has got 10 different things that he's going to do. Some of them good ideas, some of them are a bit rehashed ideas, but if I look back and so in terms of the sort of renewable side of things, somebody quite rightly pointed out that 20 years of sustained government support for the offshore wind industry has now led to the UK being probably the leading nation in that field. So again, it's looking at we shouldn't overlook the good old-fashioned domestic energy efficiency as another area that I think is going to continue. It's not a new theme. Obviously, we've got investments into companies like Airex, PowerVault, and so on. So the Thermalon, of course, from the last cohort. Again, all developing kind of new, novel, sort of better mousetraps that are going to benefit massively from those things. And so you've got the Green Home Grant in the short term. Again, announcement of extension of that drives the very best energy efficiency products, and I think Airex in particular is going to see a huge set of orders coming in the next year, because if £5,000 you can get a sort of an Airex system installed in your house and have £4,000 of change. So it's really going to benefit from that side of things. And then sort of thinking about sort of corporates, we've not only got we're obviously engaged with the Schneider Net Zero Home Challenge, but also we're now part of an Innovate UK Accelerator, what they call an Accelerator program in chemistry and biochemistry, and actually Thermalon are part of that cohort. But what that gives us is access to companies like Unilever, and who are obviously looking about how they take their kind of unsustainable solutions and make them sustainable, and that clearly creates an exit route for companies that we can spot, let's say, through these other channels, because we know that corporate R&D, that's going to be your sort of first point of call for an exit. for those kind of circular economies. So sort of, again, better mousetrap type businesses.
Thanks very much, Andrew. Yeah, I mean, the wind and renewables, but particularly wind versus circular economy, it's really not that long ago that if you tried to put a circular economy business forward, you know, nobody believed you could make money from it, and it was, you know, think again, you know, we just want better wind turbines. And now, as you say, the Attenborough effect, you know, we've just run a call for applications for our fund 4 and had over 100 applications, with definitely a heavy skew in circular economy, whether that's reuse or kind of smart new materials. Really an area that has kind of finding its feet, I think, and maybe Fund 4 will be, you know, will have a number of those in it. Thank you, Andrew. Chris, you know, same question to you. What do you feel are the themes for 2021 that will kind of be the sharp focus for our fund?
Thanks, Susanna. I think, first of all, above all, it's important that we aren't distracted by the short-term impacts of the pandemic. That isn't to say that I think all of the impacts will be short-term. I think there will be significant structural changes as consumers begin to value their things and their time in different ways and move and use space differently. But we need to make sure that we don't rush into make hay while the sun shines opportunities that might not prove sustainable once we move past the first phase of this pandemic. I have very limited interest, for instance, in service businesses that are trying to replicate forms of face-to-face interaction that are just much better in person. Things like video conferencing and remote medical diagnosis tools are definitely going to prove a much bigger part of our lives post-pandemic, but digital wine tastings or virtual reality holidays, I'm really not so sure. One area that I continue to be particularly excited about, though, is mobility or future transport solutions, if you prefer. Lots of people might say that's old hat, you've missed the boat, and the real early stage opportunities were on the table 5-10 years ago when we were launching eCar, for instance. But I rather disagree. I think if you were to look at one of those hype cycle graphs that I'm sure all of you are familiar with an innovation trigger, a peak of inflated expectations, and then a trough of disillusionment. High profile technologies in fields such as electric vehicles, autonomy and asset sharing are rapidly moving up the slope of enlightenment towards the mainstream, and with them bringing all the supply chain and new business model opportunities that go along with that. Add to that the supportive regulatory regime that Andrew has spoken about and that we're all expecting, even if the 4 billion that Boris has announced is pretty paltry in the scheme of things, and very encouraging investor sentiment further down the track. I think mobility remains a sector to really watch, and one where the execution abilities of the team will be key in particular as it becomes less about the novel technology and more about how it's applied.
Yeah, I mean, when we saw them move forward the EV deadline, as it were, from to 2030, that surely has to also drive innovation in the both electric vehicle technologies and in particular in the infrastructure for charging.
Yeah, I think it definitely will. There's a stay of execution for another 5 years or so for kind of hybrids, so we're not going to see that kind of wholesale move. I think infrastructure is going to prove one of the biggest challenges there, and with those kind of challenges comes opportunity for those with novel business models. But I don't think in those sectors now it's really about the technology. It's about how it's applied and how it's scaled up. And frankly, that's very much in our wheelhouse. We're never going to develop and build an electric car or support a business that does. It's just far too capital intensive. But absolutely, we're going to support business model innovation that allows those assets to be used in smarter ways.
Yeah, brilliant. Thank you, Chris. Peter, can I turn to you? You have been investing in this space for many years and have seen the ups and downs of. I didn't know how to do that for a really, really long time.
Since 2001. Let's get it out there.
You've seen many of the cycles that the
Yeah.
clean tech and later the
Yeah, I mean there have been cycles. But I think one of the things that really struck me was a comment that you made in your introduction about offshore wind, and I think it's been really, really interesting over the last 12 months, and whether this has been driven by COVID or whatever, that technologies and sectors and spaces that were even 10 years ago regarded as novel or high risk are now mainstream. I mean, I think many people will have a renewable energy fund in their personal portfolio somewhere, which is there for yield, not for capital gain. And what we're seeing and have seen in the portfolio is some really attractive businesses that are providing services into offshore wind or what have you. And Senan is one, which is about optimizing and driving efficiency into renewable and other technologies. And I think that's really interesting because from a risk point of view, these are relatively lower risk businesses, but equally highly innovative. So we're seeing with the maturity of some of the renewable technologies that actually creates opportunities in the support businesses and down the supply and support chain, which are very attractive opportunities and which I think, as Chris said, aren't profoundly capital intensive because that will never be our business. So I think we're seeing and we'll continue to see a lot of innovative and entrepreneurial opportunities that are being brought forward by what 10 years ago was innovative technology at the top end becoming mainstream. And I think that's really interesting. And I think that is a lower risk and earlier exit opportunity for investors. But equally, on the other hand, there are some very significant new opportunities and areas of innovation coming through. And, we've done some very interesting deals around agricultural technology. Again, dry grow comes out very strongly in that, where you're addressing some very significant problems of sustainability in agriculture and the production of feedstock through innovative technologies which are much, much less resource intensive. And we're seeing a great deal of interest in those. And I'm sure many people on the call will know, dry grow has raised significant amounts of money at valuations significantly ahead of where we came in. We'll be seeing lots of businesses in that space. And I think we'll be seeing lots of businesses that are being driven by changes in the regulatory environment. And I think that's going to give us some very interesting and exciting opportunities to invest where there will be novel business models, and for their very nature, I don't know what they are, but I'm really looking forward to hearing from some of those, 100 or so businesses that we're currently sort of winnowing our way through to sort of take the initial presentations from them to hopefully, make start the first 3 or 4 new investments for the coming portfolio.
Yeah, it does. Thank you, Pete. It does feel like a slightly unexpected sort of outcome from the pandemic is that people are focusing more both on the sort of impact of their diet, but also on food security, the kind of rapid growth of the vegan diet, understanding sustainability in our food choices, and food security and how kind of agri-tech efficiency can help secure that. It does feel like maybe it's the queues at Sainsbury's and the fear of not having food during lockdown because we can't go out to supper, but that certainly feels like a theme that's resonating more.
No, I think that's right, and there's a growing awareness that certain elements of the agricultural production chain, at scale, may not simply be sustainable. And there may well need to be some radically different ways of addressing these problems. And I say, I don't know whether why is it? I mean, is it because people link the development, the emergence of pandemic diseases with some of the characteristics of intensive agriculture? I don't know. But certainly, I hope that we'll see some very interesting and innovative technologies in that space, whether it's, like dry grow, much less, lower resource intensive ways of generating feedstuffs, or whether it's something like, alternative pollination technologies. We're seeing some of those. There's just loads of stuff there. But I think the big thing that really strikes me of this year is that, going back to when I first started in this space, sensible people didn't really believe, many sensible people chose not to believe, are sensible, that there would be a sustained transition to a low carbon economy with lower resource efficiency. And that was actually quite a radical statement 20 odd years ago. Nobody thinks that's radical now.
Yeah.
And that fundamentally changes the environment in which we're operating for the better, I think.
Yeah, thank you, Peter. So moving on to something a bit different, we're raising our fourth fund. Across the previous 3 funds, we've made 22 investments, and we were talking amongst the team about what might people dropping into this call be interested to know. And someone said to me, I think they'd really like to know what you wouldn't do again because it went wrong previously. So we know that we often learn more from the things that went wrong than the things that went right. So to put that question to you, maybe to you, Chris, what have been your key learnings in terms of what you definitely don't want us to do in the next set of investments?
Yeah, happy to answer that. I'm seeing Andrew perking up there. I don't know if there's something you wanted to throw into the mix, Andrew, before I steal your thunder.
No, that's fine. I thought we were going to. I was going to lead in my turn. If you don't mind, if I could do that, just to say before.
Sorry, Andrew.
Yeah, I mean, I'm just coming back to sort of learnings because I think Peter's just pinned me to it. But and I was going all the way back to first venture, low carbon venture I was launched was called Connected Energy back in 2004, and I think I'm up to 18 now across myself and the teams I've been involved in. The reason you haven't heard of Connected Energy is it fell over, and the kind of key insight I got from that one was around. I mean, it comes back to team ultimately, but around sort of looking and understanding, yeah, I say the business model. And there's a saying about very few business plans survive first contact with a customer, and it's a bit of a it's actually there's quite a lot of truth in it, and therefore having a team that was flexible, that can take that business model and adapt it. And find something that actually does work, that customers actually want. And that was, Connected was a great example of what we thought was a really simple business model, and sort of arbitraging heat and putting in pipelines and moving stuff. And it turned out that actually, as a heat doesn't have any waste heat doesn't have any value until somebody offers to buy it, in which case it's whatever. So it became a very difficult thing, and actually the management team at that time. Basically kept bashing their heads against the wall for 18 months until the money ran out, and of course no progress. So again, I think we look at that, and we see that in terms of investing is looking at, it's not necessarily the investments we make, it's not necessarily is this going to be the final business model, but because they're not early enough to have actually got that traction. But it's understanding that, okay, are the team adaptable? Do they listen? Will they realise what's not working and adapt themselves? That does come down to a lot of that is about teams that people who say this is the business model and come in and are very, very assertive that they're going to take over the world and this is exactly how the business is going to operate and how fantastic a thing. It always just sets my I guess I sort of learn from that's a sort of a bit of a warning sign, that because it's going to have to adapt, and we've seen that with companies like Circular, being in the hospitality and retail sector. They have to adapt, and that's how you get this survival rate. As Susanna said, there's 21 out of 22 businesses still going in the investments. I think that's that's pretty impressive, because people have learned to adapt and have not kept on bashing everything at the wall. And the other thing that I guess I sort of learned was something that we've applied when we're putting our own sort of money behind ventures, is that there's funding path through to exit, and it's vitally important. I think Chris referred to it earlier about sort of capital efficient businesses, but unless we can see who we can sell this to, and how we can, and where we will go to get that money to go through the funding rounds required, it's almost a kind of it's a bit of a no-no. So when you see people who say, I need £10 million to build my first pilot plant, let's face it, these days there are no venture capitals, certainly in Europe, that will write those kind of checks, that will take that kind of technical risk, and therefore, as much as they will change the world, we just don't get involved in them. So you come back to sort of dry grow. The great thing about it's a modular business. I mean, it will get there, but they can demonstrate. They can do a first technical demonstration on $500,000 to $1 million, which they've done, and now that's why they've been able to attract the next stage of funding. So I think that's those are two key things for me.
Thank you, Andrew. I just want to make a point of clarification that Andrew was talking about a business called Connective Energy that lived and died in the between 2004 and 2010, and is not related to Connected Energy, which is very much alive and well in our Fund 3. It was nice that you chose that example, actually, because we still have team chats and referrals to things that happened in the Connective Energy deal, because actually we all worked together previously at Carbon Trust. So that deal, which did go wrong, is still used kind of as a case study point of referral for us in the current team. So it was nice that you used that. Chris, if I could ask you the same question about things that you've learned from bad experiences that will inform how we do things better or don't do things the same.
Yes, certainly. I slightly regret allowing Andrew to go first, because he's stolen a few of the things I was hoping to cover. But first of all, I completely agree with him. Decent ideas are to a penny. Exceptional teams are not. So the team is going to be absolutely critical, and I don't think that's a new learning. I think that's, frankly, if you speak to any investor, they will always have that at the top of their totem pole when they're considering early stage investments. But in particular, I think coachability and kind of self-awareness are absolutely crucial. I always like to undertake an informal hubris test, really, if you will. Do the entrepreneurs know what they're good at and know where their weak spots are? And will they seek and accept support where they need it? And that can be a very difficult line to walk with entrepreneurs that almost by definition are quite confident in their abilities, and you want people that believe in their business model and their own capabilities, but you need people that at the same time are reflective and able to identify where there are gaps to fill. Another key thing for me that has really come to the fore this year is downside risk management for quite obvious reasons. Does the funding round that we're looking to put together provide a kind of good runway, and is there reasonable contingency? And are there kind of realistic pathways forward under a whole variety of different scenarios, including some severe downside ones where, for instance, it proves impossible to raise follow-on funding, or an entire market evaporates overnight, as has happened for some this year. And I think really we like to avoid investments that have a narrow pathway to success. Now that isn't to say that we're risk averse. We certainly aren't, and you can't be in the early venture space. But we really like to focus on opportunities where there's the opportunity to enhance the business model or to pivot if required. I particularly also like opportunities that combine solid recurring revenues on one side with technology linked upside on the other. So from our most recent cohort, Minviro are a good example, that have good, solid, fairly recession-proof, touch wood, consulting revenues coming in, whilst at the same time developing some market-leading software, which could suddenly turn them into a kind of SaaS type multiple at their future funding rounds. And having that kind of balance allows you to know there's a very high likelihood the business will be able to survive difficult economic times, whilst at the same time not really prejudicing your upside. And if you look through all of our previous portfolios, there are quite a few that look like that, and probably one of our leading lights from the very first fund is Rovco. Who had, again, good, reliable revenues from contracts they were already winning and delivering, weren't high margin, weren't going to set the world on fire, but they gave them a platform on which they could build novel technology that was going to give them a real lead in the sector. And the combination of the two is what really gets me quite excited. I haven't really talked too much about things that have gone badly, simply because I don't want to name specific organizations that are kind of still trading. But I think in all cases, those points have kind of come to the fore, that we do need to back teams that, as Andrew said, are adaptable, and businesses that can prove resilient to a variety of different scenarios.
Yeah, brilliant. Thank you, Chris. And Peter, again, a wealth of experience. Presumably, you've seen as much, several things go not so well as have gone well.
Yeah, I've seen over my career many things that have not gone well. It's sort of the nature of the business, but equally, without getting too complacent, I think to have only lost one business out of 22 investments over a period of 3 years is pretty good, and I think we should note that and be proud of it. But I think the one thing I have two things possibly that I would think we need to remember and learn is that when we look at a business and when we do our initial due diligence on it, all we can really do is take a view as to whether that business has a sufficient set of the necessary characteristics to succeed, and we simply do not know whether the business is going to be successful or not. And we sometimes misjudge the management team, sometimes we misjudge the market, sometimes the technology development trajectory is too ambitious, and sometimes simply it will not work when you get it to a later stage. And we simply do not know that at the beginning of the investment process, and neither can we know that. So that leads to two sort of things that are absolutely critical. Firstly, the management team, as Chris said, has to be able to develop and pivot, and to sort of take into account reality as it is, as opposed to reality as they wish it were. And the other point on that is portfolio. I don't think I could have. I mean, let's take an example. Good Clubs. In our first portfolio, Good Clubs has done incredibly well because of a whole variety of circumstances. It's got good management team, it's got an innovative product, but the world has changed in a way that has helped Good Clubs, in a way that the world has changed in a way that has not helped Circlet, which I think also has a tremendous manager and entrepreneur who actually has been able to pivot and move with the flow. But we could never have forecast that. and we should never believe that we can. So it's critical that we have a portfolio approach.
Yeah, and we've actually had a question in kind of which I think relates to this. So Giovanna asked us, what do you think is the advantage to invest into, I presume, into sustainable accelerator, into a fund versus, say, investing directly via one of the crowd platforms and choosing sustainable business clearly?
Well,
so what's the kind of fund versus direct pick benefits? And I think you were going to go on to talk.
Yeah, I can address that directly, actually, because however experienced you are, all you can ever do at the first point of investment is do due diligence to establish whether there are sufficient conditions for the business to be successful. Not that it will be successful. You will never know that. And I think, without wishing to make a general comment on the level of information presented on a number of crowdfunding presentations, it needs a lot of due diligence to establish those criteria, whether those criteria are there or not. And we are able, because of our focus, to do that due diligence. So I question sometimes whether it is possible to do that due diligence simply by reviewing the material that's up on the on a site. The second point I think is also critical is valuation. We negotiate on valuation, and what experience tells you is that every entrepreneur rightly believes that their business is going to be incredibly successful and will have an opening valuation predicated on that belief. And we want our entrepreneurs to believe that, because that's what drives them. Unfortunately, because we've been doing this for nearly 20 years, we know that that belief is often ill-founded, and therefore you need to go into you need to invest in a business at a valuation that reflects the true risk and likelihood of success, which will always be lower than the valuation presented by the management team. So therefore, why I think investing through a fund is the right approach. It gives you proper diversification. It gives you access to proper professional due diligence, and it moves the valuation metrics in your favor. I'm sure Chris has got a lot to add on this, answer you, Susanna, but I'll shut up now.
Yeah, not too much to kind of add directly, other than to hugely agree, particularly on the valuation point. I think over the last decade, it has become a rather terrifying seller's market in the kind of early stage investment world, driven by the tax relief that's on offer and by crowdfunding sites where valuations are directly entrepreneur set. And it's resulted in frankly some quite unsustainable valuations at the pre-seed and seed stage. And we spend a lot of time telling entrepreneurs that it's not always in their best interest either to take funding at the highest valuation they possibly can. It can set you up for quite dramatic failure if you are required to pivot, or if you don't hit your quite aggressive targets and find yourself fundraising again in a year or so, really unable to substantiate much of an uplift. And therefore looking at kind of down rounds that can be quite disastrous in terms of their optics. So I think that finding the right ventures at the right valuation is absolutely key for us. But other than that, very much agree with what you said, Peter.
I suppose the other point to add to that is that specific to Sustainable Accelerator is the support program and oversight. So many of the ventures are resident in our building, and they will pop in and ask us a quick question, we'll try to help them, including the days that we'll see them when, you know, things have, you know, they've landed a contract, but also the days that things have gone really badly. And I guess we've got a level of oversight through proximity and through our support program that as a kind of arm's length angel investor wouldn't be available. So I think that is a huge contributing factor to the relative success rate of 21 out of 22, is that we can get involved quickly to try to help. We've had a few more questions in, which is fantastic. Please just pop questions in the chat box if you have them. So Frank has asked, not speaking about mistakes, but about missed opportunities, even outside of your own deal flow, what is the startup you would have loved to have invested in this year? It's a good question, isn't it?
It's a good question.
Chris, are you up for it?
Yeah, sure, certainly. Okay. Yeah, it's always a painful subject for investors of any kind. Frankly, there aren't too many examples from this year for us thus far. I'm really proud of the fact that we continued to invest throughout the kind of worst of the pandemic and the first lockdown, including a number of investments into ventures where we hadn't met the entrepreneurs face to face, which is obviously quite frightening. But we have been able to continue to identify the best opportunities and to act quickly. Looking over the last 2 or 3 years and the previous funds, there is always one that immediately jumps to mind for me, that I'll talk about quite candidly. From our first fund, which was an opportunity to invest into a business called Disperse, which is the providers of real-time construction tools, essentially underpinned by sensors and the production of digital twins to give a kind of real-time analysis of how a construction project is progressing. Fantastic team, fantastic technology, and we had the opportunity to invest at the pre-seed stage ahead of a Series A that they were already talking about, and it got away from us. In the end, they managed to actually land their Series A investors early, take on a lot more capital a lot sooner than anticipated, and we missed the opportunity. And it was always quite a small window for us. And I think if I'm completely honest, we missed out on that in part out of arrogance, out of a belief that they really needed to take our money, and they absolutely should, and we weren't listening to necessarily what we were being told by the entrepreneurs about the reception in the market and the other investment opportunities that we had, or that they had on the table. And so I think we missed out on a deal that was there to be done if we were a little bit more humble. Actually, on this occasion, perhaps some were a little more accepting of their valuation. And if we had been, we'd have seen a 2x uplift in a matter of about 4 weeks. And it's a business that I know is valued at around 30-35 million now, and going great guns. So that's the one that pains me the most, in particular because I think it's our fault. We could have closed the deal, but we've learned from it.
That pains me rather more because I think that's probably my fault, actually, if we're going to be entirely blunt about it. So yeah, no, I think that I would agree with Chris on that, and I think that's enough pain on these deals for any one evening, frankly.
I was going to say, this is an investor panel, not a therapy session.
I've got enough therapy sessions. So
when that question came in, I also gave it some consideration and thought about probably as a kind of subsector sort of cluster. We've missed a few in agri-tech. Like, we've wanted to get into agri-tech, to make sure we've got a full range, and there have been probably 3 that I can certainly think of 3 that we made offers to and we didn't manage to close them, largely for a combination of it just got away from us too quickly, and the valuation point. We found some valuations in agri-tech to be a bit higher than perhaps we were comfortable with. There was a business teaching flies to pollinate like bees, and I just thought it was fantastic, and they got a big investment offer from agri-tech based incubator in California, which is likely to be their target market, etc. And they took that instead. So fair dues. But there were a few in agri-tech in that fund too that we didn't quite manage to land that I think we would have liked to have done.
Yeah, I think that's probably true. So, certainly, I would like us to have some more exposure in that space, because I think there are some really exciting opportunities. But I actually don't regret walking away from any of the specific deals that we had on the table, because
I agree.
I don't think they were correctly valued. I would have loved to have made the investments at a valuation we were comfortable with, but as a sector, particularly when it's come to alternative protein sources, as an example, it's become really hot, and there's a wall of money that wants access to those kind of opportunities, and it's leading to kind of escalation in valuation that I just don't think is sustainable. So I regret that we haven't been able to make those deals work. I don't regret walking away from them when we couldn't get the right valuation.
Yeah, very good. So we've had a slightly different style question in from Jay Hardiman. How long has the team been working together? Oh, this is going to be painful, guys. And do you usually collaborate on deals or take a lead on your own projects? Who wants to admit how long before knowing each other? Sorry?
Do you want to answer that one yourself?
Yeah, okay. So I first met Peter and Andrew in 2006. They already were working together at Carbon Trust, with Peter leading the investments function and Andrew leading the venture development function. And Chris joined us there. Chris, you have to remind me, 2009?
2010, I think.
2010. So the newest relationships stem from 2010, should we put it that way? And then Chris and Andrew together founded Sustainable Ventures in 2011. So in a Sustainable Ventures context since 2011 for some, I went off and did some other things in between and came back about 3 years ago. So a really painfully long time. No, brilliantly long time, sorry.
Brilliantly long. Every moment has been a joy.
And then the second part of that question is, do you usually collaborate on deals or take a lead on your own projects? I think a bit of both, right? So I and the investment team usually lead on the due diligence and preparing. We will reach out to the investment committee for their areas of expertise. All deals that going into the investment process are presented to an investment committee where everybody has an equal vote unless they're conflicted. And then once the deal's complete, each one of the investment committee takes on a company as their kind of mentee relationship. So all the companies in the portfolio have a kind of direct sponsor relationship with one of the investment committee. But with 8 in the portfolio, I feel like we all know them all. I mean, I don't know if you want to add to that, Chris and Peter.
Yeah, I think that's right. The investment team that Susanna manages obviously lead the transactional side of each deal, and there are a number of stage gates at which they're presented to the investment committee, and will provide additional support through that process in line with our own thematic experience. In my case, that's particularly mobility, and in Andrew's, for instance, it's anything associated with processes and business model innovation. But yeah, then from a support perspective afterwards, every single company has a high level sponsor, an investment team, kind of lead contact, which again are done on the basis of our own areas of expertise.
Yeah, and just the other thing that we do is we do a quarterly review with every company and with every company in the portfolio, and everybody's invited to that if they want to attend. So when it's even if it's not your company area of expertise or responsibility, you might want to go because you've got a particular interest in either learning more about them, or you just want to keep an eye, check the other person's doing it all right. So there's primary responsibility, but also a lot of overlap. I think. Shruti, have we had any other questions in? No. Okay. Well, it's just a couple of minutes before 6, so I think unless anyone does have any final questions, we can probably move to wrap up. But I wanted first to thank everyone for coming along. It's always nice to see a number of new faces this evening, as well as some of our long-standing supporters across the previous funds and the current fund. But in particular, thanks to Andrew, Chris and Peter for being so candid in their thoughts, and hopefully they're still talking to me despite my comments about how long we've known each other. Brilliant. So thank you very much, everybody, for joining, and I hope you have a very good evening. If you have questions about Sustainable Ventures or about the fund, please do reach out to us. Investments@sustainableventures.co.uk is our email address. Other than that, I'll wish you a very good evening.